In today's video, I'm going to share with you how foreign exchange realized and unrealized gains or losses occur within a finance system, what they mean, but most importantly, understanding how the transactions work. We'll go through two different examples now. The first example we're going to go through is when we receive an overseas invoice and they give us 30 days to pay the invoice. Let's say the invoice is dated the 10th of August and in the foreign currency it's for $10,000 and the exchange rate of the foreign currency to our currency is 0.71, which means our currency value is $14,084.51. The transaction for that is we would debit the expense or the stock account and credit the creditor. That's the initial transaction. At this point in time, there is no impact on our foreign exchange. Then what happens at the end of the month when the invoice is still outstanding, so we'll say the 31st of August, the foreign currency value is still $10,000. But let's say the foreign exchange rate has gone down, so our dollar is less valuable than what it was 20 days before, and it goes down to $0.69. That means in our currency, that invoice now actually isn't going to cost us $14,084.51. It's actually going to cost us $14,492.75. The reason this happens at the end of the month is any good accounting practice would have in place updating the foreign exchange values and revaluing them at the end of every month. So there's no payment made at this point in time, hence the transaction is unrealized. We haven't actually paid the invoice, therefore it's unrealized. The transaction in this case, because the dollar has diminished in value, is debit unrealized foreign exchange gain or loss, and in this case it's a loss, and credit the trade creditors because we effectively owe that creditor more money now in our currency of $408.25. That being the difference between the original value of the transaction and now the current value of the transaction. Then it moves to step 3. And on the next day, the first day of the month, the unrealized foreign exchange gain or loss that occurred that month is reversed. The reason being is all transactions are maintained at their original value until the transaction is realized. Therefore, in this case, the $408.25 is returned, therefore debiting the trade creditors, crediting unrealized foreign exchange gains or losses. Now we're going to pay the invoice. It's 30 days later, and we're going to pay the invoice on the 10th of September. And the exchange rate at that point in time is 0.7. So we need to pay $10,000 in the foreign currency at a rate of 0.7, which means in our currency, we've got to pay $14,285.71. So you might be saying, well, what do I do with my creditors? Because my creditor is still sitting at $14,084.51. The transaction in this case is as follows. You credit the bank for the $14,285.71. You debit the creditor to pay the invoice of $14,084.51. And that leaves you a gap of $201.21. That is a foreign exchange loss, hence a debit, because the credit is for the amount we pay, the debit is for the invoice that is being paid, and the difference between those numbers is either the gain or the loss. In this case, it's a loss. And it becomes a realized loss because the money has actually left our bank account. What if we were to use the same equation, but the foreign exchange went in our favor? We still have the invoice of $10,000, but this time we've got 0.73 cents in the dollar as the exchange rate. We only need to pay now $13,698.63. We still debit the trade creditors for the $14,084.51. We only have to pay $13,698.63. We offset the trade creditor of $14,084.51, and the gap between those numbers being the credit of $385.88 is our foreign exchange gain, which is realized. we now ask ourselves the question, what if we make the payment first? Quite often with overseas suppliers, you have to make payment before you receive the invoice. Now in this case, we're going to say we're paying $20,000 in foreign currency at an exchange rate of 0.56, which means in our currency, we're paying $35,714.29. The transactions for this are debit supplier deposits and credit cash in bank. This is the initial transaction. Now we move to the end of month. We haven't received any invoice and we haven't made any more payments. But at the end of month, the foreign exchange rate is actually more valuable than what it was previously. So the $20,000 foreign currency is still sitting there as a deposit. The exchange rate is now 0.57, which means in our currency, the $35,714.29 we originally paid is only worth $35,087.72. In this case, the transaction would be to debit unrealized foreign exchange gain or loss account, which means we've lost money, for $626.57 and offset that with the supplier deposit account. But like what we did with the invoice, is on the very next day, there's a reversing transaction for $625.57 to bring the value of that deposit back to what it was originally when we made the payment. Fast forwarding now to when we receive the invoice value is still $20,000 in the foreign currency, but we're actually paying 0.55 cents in the dollar. We actually have a currency that is more valuable than what it was previously. So in this case, in our currency, that transaction is worth $36,363.64. This means we debit the creditor for the value of $36,363.64 because that's the value of the invoice. We offset it with the deposit of $35,714.29, but there's a gap, and that is a credit of a foreign exchange gain of $649.36. This means that if we had paid for the invoice the day we received the invoice, we would have paid $649.36 more than what we actually did back the month before when we made that payment to the supplier. If the foreign exchange went against us and our currency became more valuable versus the foreign exchange currency, we would have a loss in this circumstance. So we'll say $20,000 was the original payment. The invoice date reflects a foreign exchange value of 0.58, which means the invoice is worth $34,482.76. We would then have a trade creditor of $34,482.76 that we're paying. We would have a deposit though of $35,714.29, but that leaves a difference of $1,231.53, which is a foreign exchange loss, and that is realized because the amount we have paid originally is greater than what we would need to have paid that invoice as at the date of raising the invoice. These examples are the reason why I believe foreign exchange unrealized and realized values should be included in your gross profit. Think about any operating business that is importing or exporting goods that is impacted by foreign exchange. It is effectively a cost of goods sold, because the reason I'm importing product is so then I can either use it to manufacture or I can sell those products themselves to a customer. That makes it a cost of my goods sold. It's not a financing cost. We are not running a hedging business. We're not running a banking operation where that would be a cost of operations. This is a genuine cost of running our operations, and I strongly believe we need to include that in our gross profit calculation. Quick recap, we've gone through the mechanics of how foreign exchange currency transactions work, and most importantly, why we believe you should include that value in your gross profit calculations.